I think the easiest one is, it's called the junk market. And, I've been in this market for over 20 years, and I'd say yes, early in its history, these were companies you frankly have never heard of. They were used to finance many aggressive LBOs. And over a long period of time, the market has matured much more. Prior to global financial crisis, almost half the market was LBOs. Now it's below 10%. The credit quality has actually improved now to where it's mostly double B companies. But also these are global companies that people have heard of, whether it be names like a Netflix, whether it be names like a Virgin, or just business models people can understand. So one of our large holdings is Charter Cable Company, which is one of the largest cable companies in the US with $40 billion of revenue. So while you may not have heard of that company, it's a real substantial company with almost $15 billion of earnings. So the market has evolved to really a much more larger market filled with, I'd say, substantial sized companies where it was before. I'd say that's, the first misconception. I think the second is, okay, the default problem is going to be very much worse in economic downturns. And I agree it will, but when I look at the prior periods of defaults, the market has evolved much more. In 2001, 2002, you had the telecom crash, so you had a lot of companies that I'd say, had no earnings, and it was similar to the equity market financing plans that didn't have revenue. 08, 09 was the global financial crisis, and you had a lot of LBOs that have come into the market. Those, again, have gone to other markets. We think the next default cycle will be much more benign. And I use an example like this. 20 years ago, about 7% of the high yield market were wireless telecom companies. And within the US, all 50 states, every one of them had their own telecom company. You fast forward to now, the weight of wireless telecom in the US is about 4%. But there's only 4 companies left in the US. 2 of them are investment grade, 2 of them are non-investment grade, owned by investment grade companies. So in my view, just the breadth and scale of the companies have improved quite a bit. And so I think that fights the misconception that these are frankly small, bespoke, junky companies, and more companies that just have a rating that is below investment grade.